I had to explain to Papa all the numbers, all the expenses. He's a very traditional guy and he signed off on it. And I get the keys. I have no idea how to be a landlord, but I figured it out. We're just kind of those weirdos, we're just kind of one of a kind, right? But we get each other, and that's so much fun. I love that I come with products and deals that I love, that I'm excited about, because they're easy to sell. I hate that hard selling. I like being able to say, hey, this is a great thing that I believe in. We'd like you to get on board. And if it's not for you, that's okay. Let's keep a conversation going. I learned a hard lesson. It's, vet the contractor and make sure they have the capacity, the accounts in order, all of that sort of stuff. So yeah, the surprise HVAC unit on the second floor was aggravating enough, but then to find out I owed 20 grand for the thing.
Eric Burns, welcome to Lend to Legacy. We'll talk about real estate development, fundraising, all the fun stuff that we do in this industry. Let's start with a little of background. Tell us who you are, what you do. How did you get here?
Hey, Eugene, thank you for having me on. I love the perspective from a builder, developer perspective. So my primary role in the space is I pair investors with great commercial deals. I actually raise money for a number of different asset classes. And it's always through operators that I know, establish relationships. So that's how I come up with my really great deals. And then I'm able to offer those investments to my investors and also alternatives, diversification options, things like that. Landing here was kind of just a body of work of doing the next thing that made sense. I had a couple big pivots. So I was a finance major at Miami University in Ohio, which I was born and raised, still reside. And I joined the Cincinnati Fire Department and I was 25. And I stayed there for 17 years and I retired as a fire lieutenant not too long ago. During that time, I had been in real estate. Even before I retired, I had been leaning into commercial. And during the firehouse days, I always thought, man, I'm going to get a company up and running. And it was never anything but a side hustle. In about 2013, I kind of took that entrepreneurial step. That it was my entrepreneurial pivot, which was buying a first real estate property. Now, going from a finance major, firefighting, and back out and all, those were pivots as well. And it was just you kind of staying out over my skis and kind of just pushing myself. And so got in this first rental property. The numbers made sense. I sat in front of my grandfather, Sheldon, and I had to explain to Papa all the numbers, all the expenses. He's a very traditional guy and he signed off on it. And I get the keys. I have no idea how to be a landlord, but I figured it out. And from there, I went on to renovating duplexes and keeping them as rentals. I was doing mostly sweat equity. And that's when I really realized I was only trading my time for money. I was working an hourly job. I just had to be my own boss, which now that I realize I'm such a bad employee, I'm like, no wonder it was so hard. But anyways, and I realized that and I started leaning into commercial and exited the residential space because commercial was so much more scalable. And my skill set really complemented what was needed to go into that space, understanding renovation costs and timelines, and going back to my days as a finance major, understanding levers and all these sorts of things. I just really kind of get on some tangents on that story because I just love how kind of life comes together sometimes. If you kind of just push yourself, you stay a little uncomfortable, you end up finding your way into a career that's pretty neat, really. So that's kind of where I came from, what I do. But
Awesome. No, that's a great introduction. So I have a million questions, but not really specifically real estate related, but I just curious from majoring in finance to fire department, how did that come about?
it was unexpected. When I graduated from college, I worked shortly at a mortgage broker and hard selling, cold calling. It wasn't my thing. I didn't like it. Not only was I not in my purpose, I was just really didn't like the work. Right. And so then I did some remodeling with a guy And then friends said, hey, fireman friends said, hey, Cincinnati's hiring, take the test. Took the test. They offered me a job, and I thought, man, this seems pretty cool. I'm going to do this. I kept showing up. They kept paying me. All my buddies were there. I'm like, this is a pretty good thing. And it was really neat. That's been my favorite pivot, I think. Those years on the fire department, I was a very immature 25-year-old, and all the character traits, honesty, loyalty, all the hard work, teamwork, these are all things that were built into me and rewarded on relational levels throughout my career there. Personal accountability is probably one of my favorites, too. So that was a neat pivot for me. And the short answer to your question is it came up and I just kind of did it.
It's funny you mentioned in your bio that you were really inspired by economics in high school. You had this
Mhm.
wonderful teacher, and then you went to college, and instead of majoring in econ, you went to finance because you thought it would be easier. And I had an opposite background. I was trying to get into business school and I wanted to study more finance, but it seemed harder. So I thought I'd go into economics because I'm like, it's kind of common sense type science.
Oh, economics is fascinating to me. Still one of my favorite subjects to read on. Um, I don't know. I was just going off what a couple guys that graduated high school ahead of me said. Oh man, everybody fails econ 1-on-1. You don't want that to be your major. I thought, yeah, I don't want to do that. But I had AP credit for econ anyway because I had such a great high school teacher.
Right.
And this guy was fascinating. His name was Dr. Kessinger, and he was a high ranking officer in the Army. What you already find interesting, I am to learn new things. It's because I think teachers like that kind of woke me up to how much I really do enjoy leaning into new things and things like that. So he was great.
Isn't it wonderful when you have a great teacher that you can remember years later and that made such an impact on your life?
Oh, I remember his mannerisms, and he's doing these, and he was such an animated teacher, and you don't even necessarily realize you're learning because he was just so engaging and fun. Oh man, Dr. Kessinger was one of a kind. He was top notch for sure. I'm glad you brought him up.
Well, one of my thoughts a lot of times when I was studying economics is, with cover a new subject and then inevitably the subject got discovered, somebody got a Nobel Prize, and I'm sitting here listening and looking at these basic charts. I'm like, that's common sense. Somebody got a Nobel Prize for describing common sense.
Yeah.
So speaking of economics, what's your prediction for the next couple of years or maybe even 6 to 9 months?
Ooh, so after hearing everything compiled about what I'm hearing, recession, soft landing, things like that, moving forward, kind of just my staying in my scope. I think that there's still a lot of great demand driven markets. It's going to be with the so there's certain markets out there that are going to have great dynamics. There's still going to be demand driven, and there's still going to be have a great labor force. Companies moving in, so the employment base is raising, getting higher in a lot of places, and the demand is staying consistent because of that, even with the supply. So if you can dial in on markets with great economic metrics and indicators and things like that, there's great deals to be had. Um, as far as being conservative, I would 100% say there's a lot of deals that are not doing well, and that is a time. And I don't think it's anything that people were taking. I mean, there's a lot of really great people, really great operators jammed up. So I think just taking these last couple of years as a lesson and just kind of embracing some unknowns. I think you just kind of got to take your lessons, move forward, and get back to basics. Look and see what the dynamics of the market are and fall back on it's a supply and demand market. And all those other kind of metrics are just pushing those two one direction or the other. So I'm excited moving forward because I know a lot of great operators are really coming through and starting to get really great deals again. And the way they're able to do that is they get great debt terms. Most of them are going to be somewhat vertically integrated to control costs. So when they're buying deals now, they're buying on favorable terms and they are able to drive those expenses more effectively. It's less of a gamble. Hey, can we get this new contract down to this? Well, they know going in with those expenses what their expense sheet's going to look like. So exciting as far as deals coming down the road. Yeah, I don't think there's anything wrong with investors staying cautious at any time. I wouldn't say if there's an investment out there and an investor's on the fence and they're at, and their sentiment hasn't caught up with the market, that might not be a good investment for them because they're just not quite there. And what I always like to say is just like, we come in, Flowers Capital, Capital Raisers, we come in and do all the work. We want to present you with all the information so it's the easiest it can be on the investor. They can go as deep or as light as they want into the offering materials. They have access to answer any questions. But at the same time, and most people I know are hesitant to get someone in a deal if they're wishy washy and say, hey, if you're not ready for this, it might not be the right time. It might be the right deal, wrong time, because we want you to get in here and have a good experience with what's going to happen. And if it's not the right time, if you're not in that space right now, then that's fine. I like to say, financial freedom should be fun. And yeah, I believe people should establish passive income as soon as they can. Um, Invest passively. Commercial real estate's a great thing, but there's also other great passive investments. So I'm a huge proponent of passive income, get it early, get it often. But I am also an opponent of taking someone in a deal that they're not on board with. So that is actually kind of how I'll leave it. But if you are on the fence as an investor, keep your eyes open because I think a lot of operators are going to be coming up with really great deals in very sound markets.
Great, that's good advice. So you primarily invest into projects that are managed by other operators, right? Or do you operate as well?
Absolutely. So that's actually kind of reversing back to my story. When I got into residential and I did into commercial, I was operating, I was sourcing deals, putting together GPs, and it was hard. And I was learning it. And I started raising capital for a deal and learned that I needed to learn more about raising capital. So I leaned into a community of capital raisers. If you're not in a professional community or you're new to commercial real estate, anything in general, I'm a huge proponent of professional communities, even if it's a paid mastermind, because entrepreneurs, we're just different. People don't get us. To be in a room where people understand you and can support you is huge. My mother is my biggest supporter, but she doesn't understand me. When I did first get into commercial, I did do some operating as far as sourcing deals, putting together general partnerships. We had one that heartbreakingly fell through. And at that time, I looked up and I looked around and I thought, all these people that I know on a personal level are tremendous operators. And it helps them to have someone raise money for their deals. And it gives me a much better product to take to market. I look up and I go, it's a no brainer. I think of it more as look at your network and see where the collaborations are. And if you have something that somebody needs, then start looking there for opportunity because you want that win win. And knowing the operators on a more personal level to begin with was just icing on the cake. I look up and I'm surrounded in this situation that I kind of just fell into, did the next right thing, and ended up kind of saying, hey, you guys are great operators. I'm going to go solely into raising capital. When their answer was, that's amazing, we'll help you. And I go, whoa, okay. That's the power community. So I went in from doing that and then I went solely into capital raising for that reason because there are people surrounding me that did a better job of what I had as a weakness. Turns out I really enjoy the marketing and I like talking to real estate people and entrepreneurs. We're just kind of those weirdos, we're just kind of one of a kind, right? But we get each other and that's so much fun.
Excellent. So, on this show, we talk about real estate development a lot. One of the things that inevitably comes up, and the reason we get involved in projects a lot of times, is developers without sufficient track record or experience would call us and say, we've got this cool project. We're struggling attracting enough investors. We need more capital to get this done. And that's where we typically get involved and help them out. So, fundraising is a huge part of the process. Can you talk a little bit more about what it takes to fundraise for a project or to get project financed? Whether it's
Yeah.
an
So
acquisition or development, the process I would say is pretty similar, right?
okay, absolutely. So when a sponsor will bring me a deal, they'll generally have a pretty good idea of what their debt terms are going to be if it's not already secured. So from there, we know that there might be 60% leverage on the deal, something like that. So you go in, if you're coming in at 60% leverage over 70%, then you're inherently a little more risk averse, insulated from some of that risk. But when I go out and raise capital, honestly, I think it's just more of a marketing thing. I market myself, I market my product, and the know, like, and trust is another one. I got to put myself out there and speak about my product. I got to put myself out there. Hey, here's my story. But most importantly, I think it's just connecting with the right people. Commercial real estate capital raising isn't Procter and Gamble selling Tide. It's two people meeting each other that know, like, and trust each other. And that's where the caveat comes on. I don't know that when you do your first investment with a capital raiser or an operator, you trust them. And I feel like that's the way it should be. I want the best thing about a new investor is you get the chance to earn their trust and make that experience positive for them. So when you're raising capital, you have to have kind of a wide net to make sure people are seeing the deal. These deals a lot of times are so good that it does come down to who the operators are and who are you trusting to pair you with those operators. I confidently come in. I love that I come with products and deals that I love, that I'm excited about, because they're easy to sell. I hate that hard selling. That's why I hated the mortgage broker. I like being able to say, hey, this is a great thing that I believe in. We'd like you to get on board. And if it's not for you, that's okay. Let's keep a conversation going where you might have questions about commercial real estate that I can answer and get you more comfortable with the products going in. That is how I raise capital. I promote myself, I promote my product. And then from there, it's saying, hey, where are you on the comfort level? How can we help you with the education, with some of this growth, wrapping your head around some of these terms? I have an article on cap rates I wrote because they're so confusing when you're talking about what's the capitalization rate of the property versus the market capital. It's like those are two very big different things. A five-page explanation on it because I want a investor to come in and when they're doing the webinar, look at it and say, okay, I see what he's saying. Like we just talked about that cap rate thing. I want everybody to be on the same page. I speak a lot about entrepreneurship. I just like talking to them. I get the grind and I get it, and it's stressful and it puts you in a weird headspace. Conversely, I think we're a rare enough breed where we can see the upside and evaluate the downside risk more appropriately in a lot of ways. Sometimes maybe we're a little, I know I can be a little too optimistic. Um and maybe get out over my skis a little bit, but that's growth. Growing into something more bigger than you, I guess, is a neat thing. Just in general, I get to talk to a lot of people that I identify with and just talk shop.
So, what's harder for you, to find a good project to invest or to find investors to go with that project?
To find investors. And it's for two reasons. I get consistently good ideas of what people are doing, and the good deals do come. They for sure do. They will be coming back down the road. So a lot of these really great operators are going to come out. So finding the investors is the harder part. I think that a lot of people aren't necessarily in tune with how accessible passive investment is. And I think they're also, if they have been investing, skittish because of what's happening with capital calls and things like that. And it's a market. You ride the ups and the downs. And yes, it's less volatile, but there are times where you got to ride it out and you'll come back out on top, but you just got to weather the storm. And the same goes for the stock market. Um, and any market, any investment market, you cannot time it. I've been reading so much more on that, given the times that people are saying, here's the math of why you don't time the market, behavioral economics, all this stuff. It just doesn't work out for you. So get into great investments and keep money moving through, even in downtimes is great. A capital call should not scare you away from passive investment in the future. It should perhaps just open your eyes. And
Right.
I could actually ask you the same question, Eugene. I think there's a lot of neat stuff coming up in development. I've talked to some development operators, and there's a lot of neat things in that space. And I guess my concern would be, what's your thoughts on like building costs? Do you think there's going to be a lot of volatility in that area?
Well, we've seen volatility come down quite a bit since COVID. Obviously, past COVID inflation, it was crazy. Then interest rates went up, and then construction pretty much came to a halt. And so, what's happening is labor unions, they've got their rates negotiated. So, we know that for the most part, labor rates aren't coming down. Maybe non union labor could compress a little bit, but with this inflation and things getting more expensive, it's unlikely that labor rates are going to come down. It is also unlikely that inflation is going to persist quite as much as it has. So, cost of materials likely isn't going to go up significantly the next couple of years. Labor is probably going to stay. I personally still think that inflation, plain text, is not under control. And even though a lot of economists that are much smarter than me are forecasting rate cuts by the Fed, and so we're seeing a lot of that happening. So I don't see huge cost escalations going forward. I don't see significant reductions too. So it's probably going to be fairly stable over the next 2, 3 years. But as far as, we do a lot of multifamily development, and I love the idea of jumping in multifamily right now because, here we are, October 4, and I had to give the timestamp, right? um, for the next couple of years, there isn't going to be a lot of multifamily being built up here in Western Washington, of specifically apartments, but that is going to get absorbed over the next couple of years, and there isn't going to be any new supply of new inventory coming online. So while the economy is still forecasted to grow, we're probably near the down cycle. So it's probably about time for us to go into the next up cycle. So I think it's a good time right now, and the costs are more forecastable.
Yeah, yeah. And that's the reason I asked when I'm looking at underwriting, especially like a new build, or at least they're predictable and things like that. And you're right, man. The absorption rates and all that new builds coming online and they're getting absorbed right away. I mean, that's great for the development industry. So it almost sounds like you guys are having a harder time finding the right place to buy at the right price rather than finding a good market to build.
Right. Well, the biggest challenge right now is a lot of institutional investors are still looking for those highly distressed deals where they could buy an existing, recently built building for less than it would cost to build it. And so we hear this objection all the time. The replacement, we're buying this for below the replacement cost. Why would we invest into new development with all the risks of new development when we can buy existing? And my response to that is we're probably getting pretty close to the end of that distress cycle. Right now, with the rates coming down, the refinance options are becoming more available. A lot of lenders who had those distressed loans have been patient and waited. Some did forward with foreclosures and whatnot, but a lot of the deals got pushed back because everybody realizes that nobody wins.
Hmm.
And so, yeah, I think right now is a very good time to invest in new development. Let me ask you this. We talk a lot about risk factors, and this is something that your investors ask you about. How do you evaluate this risk, and how do you evaluate the return on risk when you present a deal to the client?
Okay, yeah. So there's like definitely benchmarks I look at as far as returns. I get an idea of what kind of returns deals are kicking off in different places from different operators and get a feel for what I think the market should dictate. And then I work backward and say, okay, this makes the benchmark cutoff for our return. So, for example, it's making a 14% internal rate of return. And then I look back and I get into the underwriting and the numbers I want to look at the most right away, exit cap and rent growth. Um, the exit cap with such an unpredictable market is tough. It's just a tough market, right? But that's a big lever to pull. So if they can go in, like I saw a deal come across that their going in cap was less than their exit cap, and I thought, okay, this is cool. This is a good thing. And then I go in and their rent growth assumptions are very modest compared to other underwriting. So right away, I know those deals are looking good. Anybody can say they have conservative underwriting, but until I look at it and I look at the certain in the model, there's certain things I want to see. And if you're looking at 5% rent growth in this great market, you're still at 5% rent growth. Like, no, that's not conservative. So the other thing I look at too is the sponsors. And a lot of sponsors that I work with are niched down into one market, one region, and they know that region really well. They might move out of one Texas city into another Texas city, or they might take the Southwest and focus only on Reno or whatever the city may be. And that came to mind because somebody said Reno's looking pretty good lately. I've seen it on a couple lists, but I don't actually have any operators there, so I don't know. But
Easily.
so that's how I work backward. Is I first make sure the returns are good, and then I make sure that it fits a risk profile. Certain asset classes are inherently going to be more risky, and those returns dictated by the market should be higher. So, like a multifamily deal going in, make sure that the rev increases aren't too ambitious. Anything that's going to increase revenue is worth a conversation worth having and saying, okay, so you think that we're going to get 3% increase over a 5-year period. What's your supply and demand look like? And which would say, absorption rates, how many available units. Also, importantly, how many companies are moving in. There's a lot of cities that are building new ports, for example. So, a new port would go in, and that brings so many jobs to build it, so many support jobs. That is a large employment base increase, which will move people in. So, that those sorts of things that are going to push demand like that. So, to make sure that if you're saying, yeah, we're going to get increases at whatever percent, that there's a reason you think that. So there are a couple definitely underlying factors that I dig in deep. So I just go from high level to low level, dig in a little deeper, and take my questions. And if they get answered, then we know we got a good one, right?
Right. So conservative underwriting, rent growth, make sure it's not super high, that it's moderate, cap rates, projections, and vacancy. Probably right.
Vacancies.
Vacancy, right? That
Hmm.
they're counting. So those are important factors when you're evaluating the model to make sure that they're conservative.
Hmm.
As
Yeah, and if you're
far
coming in and there's a vacancy rate, you don't want to go if there's an 90% occupancy rate. Go in and assume at the sale you're going to have 98% because the market doesn't dictate that. Of course, I think really kind of more taking all those elements and putting them in perspective of the market, the economic climate, and the deal itself. All these numbers can be justified, but they have to be justified. And the questions have to be asked. And things like that. People should be wanting to answer your questions because a good deal will have these things. It's like, oh, we talked about this, and here's why we think that. So a good operator is already, when I take them a question, you have an answer, or they'll say, let me get back to you. I will find that out for you. I think to make sure all the big numbers, all the big levers fit appropriately with the market and the product and the submarket and all of it. So the numbers have to be conservative in perspective of where you're operating, I think is a better way to put it.
Got it. So for a retail investor that is looking to invest passively into an existing operations like that, what type of returns can they expect?
Lately, I was seeing, let me think, I think it was probably a good right now. If I saw a 14% internal rate of return, I'd feel good about that. I've seen 8% preferred coming back. I actually have seen higher prefs, but from operators I'm not familiar with. So I would say those would probably be my couple benchmarks right now. If I could find an 8 pref and a 14% internal, that'd be a deal I'd definitely would like to look into. As far as like annuals, still about 15% would be what I would look at, and back down closer to like a 2x multiple. So
And how long is that investment typically?
usually 5 to 7 years. depending on the size of the property. If you're going 100 units and above, it's going to generally be a 5 to 7 year hold. But we were only renovating 75% of 30 units, so we could do it in a year and a half and stabilize it. So,
Got it. All right. So one question I ask all of my guests is to tell me a horror story. Tell me something that went horribly wrong and what lessons you learned. What can you share?
okay. Yeah. I was actually just thinking about this when we were talking about my backstory. The last renovation I did, I was still looking for a good GC. And the guy got recommended by a really trusted friend, and he had done good work for him for a long time. And I think what happened was he got in over his head, and I wasn't really looking to make sure he had the capacity to do it. So we're going down this road, and I'm paying him draws, and things are slow. And we have this HVAC company that he's contracted to come in, and they put the HVAC unit for the second floor in the wrong spot. They wanted to put it on the second floor, which they did after I specifically told them not to do that, put it in the basement like a normal human, and they didn't want to do that. So, come to find out, I come back 2 days later to check and see if it went in, and it did on the second floor. So, I go to the contractor. I say, "Hey, man, you got to fire this guy. He's been a problem for my project this entire time. Get rid of him." And he said, "All right, I agree with you. I'm going to get rid of him." 2 weeks later, he's hired back. He had not paid the HVAC company the $20,000 I thought he was paying them. So they come back. They're threatening to put a lien on the property. And I learned a hard lesson. It's, man, vet the contractor and make sure they have the capacity, the accounts in order, all of that sort of stuff. Do you work with the same HVAC company every time? And if not, who are the ones you use? I mean, if you're going to have to go out and find one now, this is not what I'm looking for. Those are questions I should have asked up front, but alas, I did not. And it was actually kind of the last push I needed to go full go into commercial. And I'm glad it went like that. But to get stuck with that bill after the nightmare of dealing with the poor GC, that's why I got much love for you builders out there. It's like it's hard work. People don't realize how nerve wracking and how aggravating construction things can go. Excuse me. The builders out there work hard for their money. So yeah. But yeah,
Yeah,
that was a
construction.
tough one to learn. And I guess looking back, I should have vetted him better. I should have fired him earlier. And the one thing that I should have done that is not excusable for any reason, I should have had a timeline, and I should have had a strict timeline with penalties. Even for a smaller project, I should have done that. So yeah, the surprise HVAC unit on the second floor was aggravating enough, but then to find out I owed 20 grand for the thing, I'm like, whew, that was it, and in perspective, that project was already behind schedule. I was already looking at numbers, trying to push timelines, and then all of a sudden I go, wait a second. I need to bring in a new contractor. I need that 20 grand that you're sticking with me to pay someone else to do the work you're supposed to do. So hiring the wrong guys can really, man, it can really be a tough thing. Working well with tradesmen, working well with contractors, that matters. Treating these guys well, appreciating the work they do, and building a long-term relationship with a contractor. I don't know if you agree or not, Eugene, but I think that pays more dividends, even if they're the more expensive guy. I know if I'm paying myself, I'm going to go super slow, and the quality, my tile is not going to be that great. Let's be honest. Like, I renovated those places and they look good, but it wasn't professional. And so I move slower and I don't put out the quality. And the next time I hire a contractor, it will be the right way, the right guy.
Absolutely. And for those who don't know, it is extremely difficult and a lot of times very expensive to replace general contractor midway.
Mm.
Because the new contract that you bring in, first thing they say is we're not responsible, we're not liable for anything that's been done prior to us. So now all of a sudden, depending on the stage of construction, you don't have a warranty for whatever work the other guy has done. If the new guy discovers something, most of the time it will be a time and material contract, because there's no way they can know what they're going to uncover, even if they have a very detailed set of plans. So it is extremely important to vet out the contractor ahead of time. Extremely important to have contractors involved early during the design process, so that they could estimate the job, so that they could start talking to their subs, and absolutely have existing subcontractor relationships. Another thing I would advise anybody who's going into new construction is make sure your set of plans is very well detailed.
Yes.
In your example, I'm guessing there was no mechanical plan that would have shown where the HVAC unit is supposed to be located, which is super common for residential
Yeah.
construction. In commercial, another reason why commercial sometimes is easier is because there is most often a mechanical set of plans and mechanical permit, electrical set of plans and electrical permit, and all of those things are detailed. So there's no question that a subcontractor or a general contractor needs to interpret something in the field and then potentially expose the owner to changes.
Hmm. And you bring up a good point with permitting, the permitting aspect of it. And a good contractor should have a good relationship with the permitting department, for one, but also the building inspectors. If they're button heads with building inspectors, it could be a yellow flag to me. If you want to get things correct, then it's worth having a good relationship with the building inspector and say, hey, I'm going to change what you need me to change, but I'm just kind of making sure that I'm doing it right and that I'm going to do it right next time. And then it's not an aggravation. Then it's like, okay, it's a learning process. We're learning together. I'm figuring out what you need and what the code, because codes do change. And you might not even find out a code changes until 5 years later when it's violating you and you go, oh, wait, no, I was allowed to have those breakers back at the panel instead of GCFI had, whatever the weird electrical code nuances are, you know, there's a 5 year lag for me because I'm not doing a panel every,
Right.
the codes change and you want to make sure that the guys are, you're working well with them. And the reason for me it would be a yellow flag is that if they're button heads with them, it's because they're not wanting to change something. And a lot of times that's just them not wanting to change. And even if it's wrong, and that's not, I want guys that want to do the right work and want to do it in the right way. And so,
Right.
yeah, vet those contractors, guys.
Hey, I had a litigation attorney on my show, and the key takeaway was maintain good relationships with all parties, because if the relationship gets sour and it gets into litigation, it gets expensive for everybody.
Yeah, and I actually had a commercial construction company I put together. We didn't get any traction. It fell apart. It's just a learning experience. I learned a lot from it. It cost me some money, which it always does. But man, you start getting into commercial and development, things get very complicated very fast where I know I'm trying to put numbers together from guys and I'm not the best at reading plans either. And I'm going, oh my gosh, these plans are so complicated and it can be overwhelming. So when we went and it kind of got to be bid season and we're trying to put together these huge bids, we didn't end up getting any of them and we couldn't float the company past that another 9 months. So we folded, but the relationship remained intact. Me and my business partner, I actually joked with him a handful of weeks ago. I said, you know what we needed? We needed like an implementer because we're both idea men. We needed somebody to get these ideas done. And we laughed because we both were, neither of us really, um, we both kind of just took a big leap. And again, we should have planned better. And we should have planned who's responsible for exactly what task needs to be accomplished. But throughout the whole thing, we maintained, even when things were falling apart, we still maintained a good relationship. And it's just straightforward communication and respect. And if you're having job site problem with an inspector and a builder, might be the builder.
Right. Communication and respect, those are always number one rules.
Yeah.
And of course, never fail to plan.
Yes.
Eric, any final thoughts before we wrap up?
No, not that I can think of. Just really enjoyed talking with you, Eugene, and probably have to have more conversations on development because it's super interesting. And I know kind of Eugene's work. So if you guys are looking for a great builder who just happens to have a podcast. I bet this guy's got some pretty great deals too. But yeah, if you guys want to find me outside of LinkedIn, I'm on flowerscapital.com, and I have a free ebook for you, Basic Guide to Syndication, to get you started. So
Thank you very much. Eric Burns, pleasure having you here.
thanks, Eugene.
Real estate development. Real estate development. Land to legacy.